That's where the fun part comes in as a lender, right? The benefit we bring is more leverage, speed, the ability to be flexible, right? To work around some of these odd structures, to be creative.
This episode brought to you by Suites at Madison. Meeting and conference rooms for rent by the hour, week, month, or year. Suites at Madison, where business gets done. Check them out at www.downtowntampaoffice.com. Now, on to the show.
You are listening to the Invest Florida Real Estate Show, covering topics in lending, buy and sell strategies, property management, hot markets, and tips and tools to guide you along the way on your path to real estate success. You want Florida investment real estate talk? You have come to the right place. And now, our hosts, Eric Odum and Steven Silverman.
Hello, and welcome to another episode of the Invest Florida Real Estate Show. This is your co-host, Eric Odum, along with Steven Silverman in steamy, hot Tampa.
Are you talking about the market or the weather?
It could be either, right?
They're both in sync at the moment.
Yeah, they're both in sync at the moment. You know, we've still do occasionally some multifamily here and there. We did a lot more the early part of the decade when the fruit was a little bit more low hanging, but all the asset classes are hot right now, Steven. Tampa's probably doing better than most in the office space, and we heard all the gloom and doom about the office space when COVID was coming out, and certainly it's taken a hit and it's not rebounded back to where it was. But in Tampa, we're doing pretty well, and all the asset classes I think are doing exceptionally well right now, despite the surge and that we're having with the Delta variant and some other issues that are going on there. But I mean, the market's great, man.
And in particular, the multifamily market, which was performing well, continues to perform. And so the question is, it's such a difficult market to be successful in. First, you have to find the properties, and then financing the properties and finding a deal that makes sense is the next challenge. So today's interview is really relevant because you can't have tunnel vision. You have to look at different ways.
You have to be more creative.
Correct.
Yeah, you got to figure out more. You got to be more creative and not just have this little box and expect in this market that you're going to be able to find exactly what you want. You got to be more creative in finding deals, and that's what this discussion is about. Wanted to give out a shout out to Chop Shop, who left us a review and said that nobody does Florida investment talk like these guys. Please listen. So Chop Shop, really appreciate you leaving that review. You can do so on Facebook or on our page, or send us an email. It's really best to do it publicly because those reviews are very helpful for us in trying to get great guests like the guest we're going to have today. It's important for our potential guests to see that people are listening and they pay attention. And if you've not done so already, we'd really appreciate that you take a few moments to go to the iTunes store if you've got an Apple and leave us a review, or Stitcher, or one of the other platforms that we have for podcasting. Steven, anything else before we get rolling into our guest?
We got a lot to cover, so let's roll into it. Today we have with us Ken Avalos. Ken is the Vice President of Underwriting and Analysis at Electra Capital, and he handles underwriting analysis, due diligence closings, and other various functions at Electra Capital. He is a graduate of Boston College and has an M.B.A. from the Stern School of Business. Hey, I like that. That was my school. Immediately before joining Electra, Ken was managing director at Raymond James and led the Canadian REIT equity research effort, covering over 20 companies across various property sectors. He has also spent time as the vice president of finance at First Potomac Realty Trust, a New York Stock Exchange listed public REIT, and as senior vice president, U.S. REIT research at Raymond James. Ken, welcome to the Invest Florida show.
Thanks for having me. I appreciate the time.
Ken, we really appreciate you investing time with us today. You know, it's interesting. One of the questions we frequently get, particularly from investors frustrated in this market trying to get deals done, is the timing and how to get a transaction done when you don't really fit a box and you need some time to work it out. And that's what we're going to be talking about today. But why don't we start first with how you ended up in the place that you're in today? Like, how did you get into real estate and finance and this mezzanine finance area that you're working in?
Yeah, how far back do we want to go? There's a long history there if I'm not dating myself, right?
Not Steve.
Eric goes back to the dark ages.
I was going to say, not Steven. Not that long ago. Because when it's Methuselah, it's beyond what anyone wants to hear about. But
that's right.
Yeah.
Yeah. You know, I when I got out of Stern, you mentioned the fact I went to Stern, as did you, Stephen. So when I left there, it was 2002. And interesting, I had been at Raymond James prior to going back to business school, right? And I was doing equity research, but primarily focused on tech. And so I think we all remember what happened from 99 to 01 in the tech world. So I had actually had an agreement with Raymond James to come back to Ray J after B school in exchange for, tuition, basically, right? I was kind of an indentured servant, but I viewed it as a quasi-scholarship. And but the reality was I was the only M.B.A. they hired that year because the market was in tatters, and it was 2002, really just coming out of the depths of the tech crash. And they said to me, well, we have to hire you because we paid for your university. So what do you want to do? There's no tech work for you. Yeah. And it just so happened that the REIT team there was looking for a body. And I went and I spoke with a guy named Paul Purrier who founded the REIT practice at Ray J. And he laid out his pitch for me, and it was this. He said, look, if you think about demographics and yields over the next 10, 20, 30 years, and the baby boomers retiring, the REIT market and the REIT product, securitizing REITs and real estate for the average investor and their retirement plans, that's a wave you can ride for 20, 30 years. And it was a very compelling pitch to me, right? It all made sense. Demographics, the need for yield, the need for retirement income, the ability to securitize many different types of real estate for the average investor that they would have no access to otherwise. It made a lot of sense to me. So I joined his team. And that's kind of how I got started in the real estate, the institutional real estate world. Spent 7 or 8 years there covering U.S. REITs on the research side, helping them raise capital across all different property types, everything from data centers to multifamily to storage, healthcare REITs, you name it. We covered it all, hotels, everything. After that, got the itch and went to work at a publicly listed REIT, running the balance sheet, reported to the CFO and CEO. And that was really neat because we did a lot of different stuff there. We grew by $1 billion while I was there. So it was a great way to understand the other side of the balance sheet, not just the equity side, but the debt side and the financings we were doing. And that was my job, really, was structuring the balance sheet and closing those deals and getting the money for our acquisition guys to go out and do that. Did that for several years, commuted. I was actually commuting back and forth from Bethesda to Tampa. My family was still in Tampa, and that has a short shelf life to it, as you guys know, when you have kids and whatnot. And then came back to covering research at Raymond James. I came back to the firm and did that for the last 7-8 years before joining Electra. At that point, I just needed to do something a little more entrepreneurial, and that's how I hooked up with the Electra team. And it's very entrepreneurial. And to your point about, finding solutions for, I guess, unconventional real estate borrowers and deals, that's the fun part about the job, because that's exactly what we do, what our platform is set up to do. And we have a bunch of different products that are geared toward that. So yeah, that's how I ended up there. Long and circuitous route, but, touched a little bit of everything across real estate, different property types, different parts of the capital stack, different sides of the corporate side, the fundraising side, and now really the investment side, because we are actually a fund and have balance sheet capital. And so, yeah, that's the long and short of it, so to speak.
So before we get into the product line, your specialty nowadays is in the multifamily area. Can you give us an overview of what's going on in the Florida market and address any pockets that are of interest? And a question I really would like to ask is, we all worried about global warming, but it seems to me the temperature is getting very hot in South Florida. Is the market for multifamily in South Florida too hot right now? How are investors and lenders looking at it?
Yeah, not just Miami, but in other areas that maybe there's some flashing some red lights. Miami's in South Florida is the most common question we get about, are we overheated? But you know what, Stephen? It's been 3 years people have been saying the market in Miami's overheated and South Florida's overheated, and yet the cap rates continue to compress. So I'm very, very interested to hear what Ken has to say about this.
Yeah, that's a really good question. One we think about and talk about every day. We, just for your benefit, we see, and listeners' benefit, to give you an idea, we do have some context, right? We lend all the way from Arizona, across the Sun Belt to Florida, up through the Carolinas, and And we'll even go into Southern Virginia in this fund. In our next fund, we're going to expand a little bit and open the geographies a little bit more. But so the point is, I'm looking at deals that our team originates and that we get over the transom all day long across all those geographies. And yeah, it's hot. And is Florida hot? It absolutely is. Is pricing aggressive? It absolutely is across any metric you can throw out there. So let's unpack that a little bit. I mean, as a lender, we're very much worried about, obviously, default risk and the security of our cash flow. So the metrics we're thinking about are clearly DSCR, debt yield, things that matter from our repayment perspective. But, I came from the other side too. And as we're looking at sponsored deals, we're thinking about how they're looking at it on a going in cap rate basis, an IRR basis, and a replacement cost basis. And one of the benefits we have is I think I mentioned this to you guys earlier or before we got on the call, was our sister company, American Landmark, owns 40,000 units across basically the same footprint. And so we have a good sense as to what rents are doing, what fundamentals are doing. So that's a long intro into saying prices are high, but from our view right now, outside of certain kinds of deals, the rent growth, the demand growth, the population growth, the cost of construction, and the sheer demand and liquidity and lack of alternative investments, it's hard to say it's not justified, right? And so what does that mean from kind of metrics, right? I think, interestingly enough, you guys and your listeners will probably be familiar with this deal in downtown Tampa called Channel Club. So I think that got brought to market or was listed to market in mid-July. And I read an article in the Tampa Bay Business Journal talking about it, saying they're shooting for over $400K a unit. So I think before this year in Tampa, we had never seen a trade over $400K, maybe one. And by the end of this year, we may have 3 in the books. And I tell you guys, it seems like at least in Tampa, product is trading all day long at $350 a door. Miami, $400 a door.
We're talking Class A. It's Class A property.
Absolutely. Yeah. Sorry. And
Class
I should
A
differentiate
plus.
with that. Let's just talk about Class A.
Yeah.
And then we'll work down the spectrum of cap rates too and per unit prices, because we look at all of it, right? We look at A, B, and C, value add, core plus, newly delivered products. So we kind of see it all. And same thing in Miami, right? Very aggressive cap rates, in some cases in the 3s, which I know is startling for Class A product, but we see that in Phoenix. We see that in certain Florida markets. Definitely all over California, and definitely certain parts of the Eastern Seaboard. And so what does that mean? It feels aggressive, doesn't it? But then at the same time, we're looking at sponsored business models, and we have a portfolio of loans out there, 20 or 30, right now, and we see what the cash flows are doing. And absolutely, rent growth is dramatic, right? It's anywhere from 10 to 30% in Tampa, Miami, Fort Lauderdale, even Jacksonville. You're getting 5 to 15% rent growth. Orlando, as you guys know, now that the parks are back open, you're seeing anywhere from 10s on the low side, right, for really high end product that's been repositioned, to as much as 20, 30% when you're doing a value add product. And so, I don't know. It's always a tough decision. What we're trying to do is stay, if we're going to reach on the spectrum of being aggressive. And so what I mean by that is, if we're going to go high on the capital stack, into the mid 80s, if we do a preferred kind of product which is sometimes where we co-invest with someone, preferred equity, we might even go a little bit higher than 85, but those are going to be selective products, very good sponsors, very good markets, and assets where we feel like we really understand the submarket well and really have a lot of comfort with the rent growth. And so, that's the game, for lack of a better word, that all the sponsors are playing, that lenders are playing, is trying to say, okay, at this price point, it feels aggressive, but are the rents there to justify it? And at least in Florida, unless you guys have seen any different, it sure feels like the population growth is coming, the job creation is back. So.
There's no question about it. I'm curious how closely you're monitoring rent to household income ratios, and if those are starting to concern you a little bit. I saw that when you look at the overall numbers, Florida has, I think, 3 or 4 of the top 10 in the country in terms of rent to household income. So I'm just curious if you're monitoring it, if it's important to you. What are you seeing there?
Yeah, it's very important to us, and some of our listeners might find it interesting too. One of the things we do when we underwrite a deal is, and specialty lenders like us, since we're not the bank and we tend to be more aggressive and flexible and fast, those are all kind of the edges we bring. Well, we have to make up for that in being a little more, for lack of a better word, detailed in our underwriting, right? So one of the things we'll do is we'll order what's called a lease audit, and we will actually hire a third-party company, or we'll let the sponsor hire a third-party company to go in, audit every lease. To your point, understand the incomes, what kind of employment characteristics the tenant base has at that property, and then the ability to withstand those rent bumps that are coming down the road if it's a value add kind of project, right? Sometimes we're looking at a deal actually right now in Largo. I think the rents are $850 on average per unit right now. The sponsors, and competing properties are $1,000 on average, right? So they're well below the market. It's a little bit of an older product, but still really nice in a great location just off Almerton, mid-70s vintage. They're going to come in. I think they're going to buy it for about $130 a door. They're going to put in about $20 a door, which we view as a pretty heavy lift. You know what I mean?
Sure.
And they're underwriting $200 rents. So in this scenario, to your point, the current tenant base we know already is not going to be able to absorb that rent bump, right? That's a 25-30% rent increase for these tenants. So they are prepared to really turn the whole building over. That's in the business plan. And as a lender, we'll go in and say, okay, let's understand that. We may have to set up an interest reserve here to make sure that, if your occupancy goes down to 50%, that you can actually still service the debt, et cetera. And those are the kind of structures that we'll work with a borrower to understand what your point about rent to income, and then our protection as a lender as well.
Let's talk a little bit about your product, because folks who might not have worked with a mezz finance, they might not really know what that means. So let's start with the ABCs of why you guys exist and what service you provide to the market.
Because really where you exist is in the space of alternative financing. So maybe you could just explain what that is and then go into the subsections of that.
Yeah, mezz financing, bridge financing.
Yeah, absolutely. There's a lot of lingo and whatnot, but let's try. I'll try and paint a case study, and you guys tell me where to expand on it or cut back on it. But here's how I think about our role in the market, right? A traditional borrower that's going to buy a property that's right down the fairway, that may not need a lot of CapEx, and they're well capitalized, and they're just buying it maybe a buy and hold kind of property, or not really an entrepreneurial sort of borrower. They're going to go to an agency, and by agency I mean Fannie or Freddie, or maybe a bank, a traditional community bank, or if it's a big partnership with some doctors and lawyers, they might go to an insurance company, maybe, right? Maybe sure. Not. But that's going to be 10-year fixed rate money, a little bit like what we're all used to seeing on our house. It's going to be low rate. The downside of that is, that's real attractive, right? That's a really attractive piece of capital. Low cost, long-term fixed rate financing, right?
Yeah, Fannie Mae, Freddie, the agency, that's sort of the gold standard that everybody's wanting to shoot for.
Yeah. The problem is, and even a bank that'll give you a similar kind of product, the problem is time, execution, their equity requirements from the borrower side, and then leverage. The problem is none of those scenarios are going to give you more than 65, maybe at best 70% leverage. And frankly, in today's world of 3 to 5% cap rates, if you're buying maybe some C product in a gentrifying neighborhood, maybe you can do better and get in the 6s and 7s. But I feel like even that's a stretch these days, unless you're playing in really, really aggressive sort of repositioning product. It's hard to generate a decent IRR with that. And so where we fit in, and on top of that, their underwriting criteria are pretty strict in terms of cash flow coverages and other criteria, borrower related. And so maybe this is a better time to talk about the kinds of products to help alleviate that problem, so to speak, and then how we would come in and structure something like that. So, a bridge loan product, we would call it bridge to perm sometimes. Some people call it stretch bridge. But it's exactly what it sounds like. It's a bridge from the current state of the property and the current cash flows and qualifying criteria. It's a bridge loan to allow you as a buyer, a sponsor, to work on the property, execute on your business plan, and then drive the cash flows and have a much more lendable product at the end and extract some equity ideally and generate some IRRs and get a better piece of paper on it, a cheaper piece of paper on it at the end. But there's a lot of wood to chop between point A and B. And so we can come in as an alternative lender and say, okay, we understand your business plan here. And this is kind of the edge that not just Electra, but other alternative lenders bring, right? Most of us are real estate guys. We've been, around the business. We understand the CapEx part of it, the value add part of it, the deal structuring part of it, constraints on liquidity, the ability to be nimble. All of those are the benefits of going to an alternative lender, a bridge lender, a mezz lender, right? And even pref equity, we do the same thing. And all of those are just labels, frankly, for just alternative capital, right? That isn't a traditional loan. And so that's what a bridge loan is. And that's going to go, depending on, the criteria, that could be as much as 85% of the capital needed on the total project, right? So that's not just the purchase price. So let's say somebody's going to buy an 8 or 10 unit apartment building, and they're going to say they're going to put an offer in for $1 million. That's the purchase price. Then there's another 100 in CapEx and maybe 100 in closing costs. So the total project cost would be $1.2 million. In that scenario, we would lend 85, right? Assuming we like the asset and the sponsor's qualified, we would lend 85% against the $1.2 million, not just the $1 million. So that's a big difference for borrowers, right? Because not a lot of people are willing to fund the CapEx. We'll put that in an escrow account. At closing, we'll put it in a separate bank account, and then the borrower will come to us, every month or every 2 months, say, here's kind of the business plan, here's my expenses, and we'll draw off that reserved account until they draw the full amount of the loan. And that's it. And usually these are loans, the bridge loan is structured, 3 years with a couple of extensions predicated on the sponsors executing on that business plan. And to your point earlier, achieving the rents, et cetera, et cetera. And so that's the bridge product. That's kind of the all-encompassing one. Much easier to understand than kind of some of the mezz and pref products. That's just a big loan to kind of bridge your property and let you do your business plan and get to a better spot with the property. So,
question on that is as to how do the rates differ as to what would be with conventional lending?
I was going to say, all this picture you're painting sounds beautiful. Why go to Fannie Mae and Freddie Mac? But as we all know, there's no such thing as free lunch.
Yeah. Hey, Stephen, I don't know if you remember, but there was a professor named William Silber.
I remember him. Yeah.
Yeah. You remember Professor Silber, and his opening line in Finance 101 was, there's no free lunch, right? And always remember that. So that's where the fun part comes in as a lender, right? The benefit we bring is more leverage, speed, the ability to be flexible, right? To work around some of these odd structures, to be creative. But that's going to cost you money. So let's just say, today quotes for senior loans between 65 and 70%. I would say the best you're going to see is 3, maybe a little bit under 3%. More generally, it's 3.5. That's kind of all day long, right? If that makes sense, pretty common. Once you start layering in capital and that extra chunk of the capital stack, if we're going to go up to 85%, you're typically going to see paper, not 3.5, but maybe 4.5, right? So 150 to 100 basis points spread, depending on the risk in the project and how much more of proceeds we're giving to the project. So, that's what we get paid, because I would position it this way as well. Once you get up past 80%, whether you call it mezzanine debt or pref equity or whatever, the characteristics of those cash flows are much more like equity than debt. Yeah, even though we're secured. Yeah. Yeah. Your leverage works both ways, right? So, so that's the cost of that, which frankly, I think is pretty compelling. Like if I'm capital constrained, I'm a sponsor, I need to go out and get a couple $1 million or $1 million for a project. I've got 3 or 4 buddies and we're ready to do this. And we know we're going to make a lot of money in 3, 4, 5 years, but we need to get that extra leverage. It's a good product, right? And we can move quickly. We can typically close on bridge loans within 45 days. Yeah, we're pretty nimble that way. And like I said, we really understand the projects and the real estate side of it. So that's our edge on the bridge product, right? And there's a lot of guys like us that do this, but we're all going to be pretty similar in the way we underwrite deals and the loans that we structure, if that makes sense.
Yeah, and for our single family guys, it's sort of that hard money, that private money. It's those guys are going to be a lot more aggressive than the banks would be in trying to get deals consummated. And if you're going to make a 60%, a 50%, a 40% return on your equity over the course of a year, why do you care if you're paying somebody 15, 20% of that? Who cares? It's like,
Yep.
yeah, you're getting a large piece of the pie. So what if you're giving up a big piece of the pie? You would have no pie if you didn't have someone like these guys doing this business for you.
Yep, that's exactly right. And, in some cases, it's one of the really interesting things about the job is we see so many types of deals. So we don't only lend to small capital constrained or newer kind of borrowers. Like, that's the exception, really. Most of our borrowers are pretty well qualified, but for whatever reasons, they like the flexibility of the bridge product, right? Once you put permanent financing on something as well, don't forget, there's typically prepayment penalties and defeasance costs as well. So it really handcuffs your capital for a long time. And where we are today in the cycle, right, going back to sort of thinking about pricing and where we are in the cycle, I'm not sure anybody wants to be constrained and told, hey, you can't exit whenever you want from your product. And we allow those things, right? And so there's a lot of benefits. I tell people, look, there's a price to flexibility. There's a price to speed. There's a price to creativity and the ability to underwrite through some, all kinds of challenging things that come up in real estate deals. But we can work through a lot of that. And that's why we exist. So that's the bridge product.
And does the bridge then convert into a permanent loan at the end of the 3 years? Or?
Well, no, they have to go out and find permanent financing. But the idea being that, let's say they've taken their NOI, their cash flow from the property from, to use round numbers, from $1 million to $2 million, once you put a cap rate on that, right, they've more than doubled the value of the property, right?
That's the whole point. You're basically now able to fit it in the Fannie Mae in the agency box where you couldn't have put it in the agency box when they bought it.
That's right. That's exactly right. And so they can do a few things there. Most of our guys are pretty entrepreneurial, right? So few and far between are the ones that are, I shouldn't say that, it's a fair split. Some put permanent financing on it, extract some equity, right? Because now it's a much more lendable product. They may have borrowed, $1 million, but now they can take out $1.5 million in equity just because the property's worth $2 million now, right? And then they have cash in the bank, plus they're paid off, and they've got a nice long-term loan. They're going to leave it in the estate for whoever. Or they just sell it, right? And then go on and do the next one. I mean, as you guys know, real estate guys are always, their favorite deal's the next deal sometimes. And, it's not that fun to clip coupons when you can go out and reposition a property and hit home runs, I think, is the way a lot of our sponsors or a lot of real estate players think about it. So
let's talk about deal size. I mean, you're obviously not going to be loaning to quadruplexes. So well, maybe you do a quadruplex if it's in New York City, in Manhattan. But why don't you talk a little bit about deal size that would be attractive for you?
Yeah, for our shop, we're a little bit bigger than smaller individuals, but we the smallest chunk of capital we would like to put out at Electra is going to be $2 or $3 million. That would be in a mezz position or a preferred equity position, and we'll talk about those structures in a little bit if you like. Different than the bridge product. That basically means we're coming in behind a senior loan. So in that scenario, it would be a $10 million project, right? Or a $12 million project. Somebody's going to borrow 10 or 12. The senior loan might be 6 or 7. We're going to give 2 or 3 behind that and get them somewhere in the 80s in the capital stack. That would be the smallest piece we would do. To as high as, we're looking at projects right now that are $130 million with $100 million loans against them. Yeah, so we'll look at the whole gamut. Yeah, we'll look at everything from a deal size perspective.
And will you look only at multifamily, or would you look at other asset classes?
Yeah. And I'll just take a step back and say, but on average, most of our deals are 20 to 40 million. That's kind of the sweet spot. I'd call that the mid-market, right? And that's on average where most of our product falls out. But right now in this fund, we're a balance sheet lender. We have a fund. It's almost $300 million of capital we've raised. We've deployed a little more than half of it, maybe 2/3 of it right now, just given hard commitments on the books that we're going to close by the end of September. We're only doing multifamily. However, we are raising another fund probably starting at the end of this year, and we're hoping to carve out maybe a little space for self-storage or industrial. But our background is multifamily. Everyone we work with is multifamily. Our sister company, American Landmark, is multifamily. And so we stick to what we know. We're good at it. We have a good niche here. There's plenty, as you guys know, multi is the largest property type in terms of volume transacted, as well as just overall stock. So, it's a good market for us. We have plenty of room to grow. So we're going to stick to what we know for now, it seems like.
Why don't you talk a little bit about that mezz and preferred equity? As discussed, because of the aggressive nature of how you guys operate, it really kind of looks more like equity than it does like debt. Why don't you talk about maybe a little bit more granular level of mezz versus preferred?
Okay, yeah, this is where it gets a little more interesting too, because I think maybe some listeners have always wondered how to fill that hole. Maybe some of the investors out there can find a sponsor or find a first mortgage for 75% of the deal. But then, you still got to come up with 25% of that capital stack, 25% of the capital stack, which is a good chunk of equity. And so the mezz product that we have, that fills that gap, so to speak. So we with our mezz or preferred, let's stick to mezz first. With our mezz product, we will go up to 85% of the stack. And so that's 10 more percentage points of the capital stack for somebody. So, on a $1 million project, just round numbers, if they've got 750 teed up, we can get that to 850. Your ROIs, obviously, your return on equities, your IRRs all get boosted with the use of leverage. There's a price to that. That product is going to be somewhere between 9 and 12%, right? On a current pay basis. And what that means is, let's say we give them $100,000 that pay us basically 9% to 12% annually on that money, right? It's expensive. It is, to your point, much more like a hard money lender. On the mezz side, we do have, we're a secured borrower, a mortgage on the property, and that's how that's structured. It's pretty similar. What's interesting is with preferred equity, we can go higher in the stack, but in that scenario, without, I'm going to use some words here and I'll try to explain them as best I can. If we go, let's say, to 90% in a deal, meaning that we'll finance 90 cents of every dollar of the total cost of that deal. In that deal, we would not only ask for a current pay, but we'd ask for a participation, what we call a kicker, saying, okay, pay us 9% on that money. And then at the end of the deal, if there's any excess cash flow and excess proceeds from selling the property on top of a minimum return that we've negotiated together, Electra and the borrower, we split those proceeds on a predetermined percentage. All that gets negotiated up front, right? Depending on the riskiness of the deal, the potential growth, the cost of the senior. There's all kinds of variables that get thrown into that. But that participation / kicker could be anywhere from 10 to 40%, right? But again, if we're putting up the equity from 75 to 90, we're essentially putting up most of the equity, but yet the sponsor would keep most of the return, even though we're getting a kicker. So I know there were a lot of jargon there, but that's kind of how that structure would work. And to me, that's a really interesting structure, because what it does is it really reduces the amount of equity a sponsor would need and allows them to participate with a majority of the upside without having to come up with a majority of the equity, if that makes sense.
It also gets another strong partner with it that that looks good on the resume when you're submitting to other investors and the guys that are not only doing this from a finance standpoint, but you guys have experience on the actual ownership side too, on your parent company or sister parent. I'm not really sure which, but so I mean,
a little bit of both, kind of.
Yeah.
As crazy as that sounds, you know what I mean? The parent of the whole organization, but partnership. Yeah. So no, that's exactly right, and it's something that really appeals to a lot of sponsors. I mean, they know we're going to execute, so the lender gets comfortable, right? They have to approve us as a preferred equity partner, and they underwrite us, Electra, so the lender can get comfortable that we're going to be there with their equity. It takes the onus off the sponsor to have to raise a bunch of retail equity and hold your hat out. That's a lot of work, right? To collect a bunch of smaller checks versus one bigger check. So there's a lot of benefits to that. And honestly, for the kinds of projects that are looking for this kind of capital, these are 25 to 40% IRR type of deals. They're more than happy to give us our little kicker. You know what I mean? They're making a lot of money on this type of deal.
Yeah, again, it all comes down to, it's so funny, Ken, that I'm dealing with something like this right now where the person's going, well, look at your piece of pie. Yeah, but there's no pie without me.
That's right.
I mean, you get no
right.
pie. Like, why is it so hard for you to understand that?
That's right.
And I can take my chips and go home and you got nothing. But it's a very frustrating situation. But I mean, the folks that are professionals that are the ones you want to deal with, they know that. Like they understand the big picture that, yeah, they have to give up a little bit more, but there's going to be no pie if they don't bring someone like you to the table.
Yeah, it's funny you say that. I mean, sophisticated borrowers, like, because we deal with all kinds, right? We'll deal with, like I said earlier, organizations that are on their second or third transaction. And, we deal with some people that are 30,000 unit owners that are well established and could go get financing everywhere. But, at the end of the day, you've got your business plan, you kind of model your returns. The most important thing from my perspective is just certainty of close. Having a partner, whether it's a lender or an equity partner that has integrity and is going to do what they say they're going to do, right? Because we see this all the time. People will issue term sheets all the time, but will they execute on that term sheet is a whole different story, right? And so, one thing that's really worked well for us is obviously just doing what we say we're going to do, executing, closing deals on time, which is another deal killer, as you guys know. And then we try to be creative and aggressive and fair. And, yeah, my boss always says, we're never going to be the cheapest piece of capital, but we're 100% transparent, and you always know we're going to sort of execute on the deal we put in front of you. And so that counts for a lot in the real estate business, I think.
Awesome. Stephen, you got some other thoughts?
I'm trying to digest all of this. There's
You're taking a lot of notes down there, madly scribbling.
I'm actually taking some notes because there's a whole world out there besides just. We're real estate brokers. We're talking to clients all the time. And, honestly, most of them are going directly to conventional lenders to do things. And there's a whole world outside that they can take advantage of and get deals that they couldn't normally get.
Yeah.
Oh, yeah. One of the things we see to that point, Stephen, we see a lot of sponsors because we have some relationship with sponsors, but generally our business is brought to us by, mortgage brokers or maybe some property brokers that know us. But we see a lot of seller financing out there, and sellers they're going to extract every last penny. I mean, we see some deals and some senior loans that if we often say to the borrower, I wish you had come to us a month earlier, right? Because we would have been cheaper. We're not even the cheapest option, but in that scenario, we would have had more proceeds and ended up being cheaper. So you don't know what you don't know till you get out there and kind of survey the capital markets. There's a lot of capital out here looking for multifamily on both the debt and equity side. And so, yeah, it's pretty interesting.
Ken, any other maybe anecdotal stories you might want to discuss with us before we let you go that was an interesting deal?
We've got so many of them. We're doing a couple here in Tampa. I think my anecdote for you guys is, when I came into this business 2 years ago, cap rates were, 4 to 7, and now they're 3 to 6, right? And then that makes sense. I think you guys have all seen that. But with that, sponsors have made a lot of money. I mean, this is a great story, all right? Because I like this participating preferred product, which is the one with a kicker that I talked about. I think it's really interesting for sponsors, and I'll give you a live example. Okay, we financed a building in Houston, February of 20, before COVID was really big in the news. So we had been underwriting it for 2 months, so we closed that deal, and it was 90% loan. It's preferred, 90% preferred. We were behind a senior loan, and I think our coupon on that was 9.5. And our equity split was 20/80, okay? The building was bought for $26 million with a big CapEx plan, et cetera. COVID comes. The guy decides, I'm not going to do any CapEx. I'm just going to ride it out because this is crazy, right? Texas got hit hard. Houston got hit hard. Where a year and a half later, he just went under LOI with that property for $36 million, $10 million on a purchase price of 26, and didn't do any of the CapEx. That's a story about what's going on. So I know Florida seems hot, but when you think about Houston, which to me, Texas is great, but they're not supply constrained at all. Houston isn't as dynamic as the markets we have in Florida. So when you see that kind of price appreciation, Florida feels hot, but it's going on all over the place. And for sure, we have it we have population growth and rent growth to justify it here. Now, Texas does also, right? They have a lot of population growth and rent growth, but nothing compared to Florida. So, just anecdotally, it's an interesting product that really worked for the borrower, and everybody's happy in that one. It's a win. Let's take it, right?
Yeah, no, absolutely. And, we have this discussion with investors all the time, and, our guys that have been in this market in Florida for a while, and they've seen sort of the zigging and zagging of the Florida market, but the general trend being up for really all of my life, and I'm old, and Steven was here before the sun was, so it's a little mind blowing for us to be able to look at this, but we have to constantly remind ourselves that probably the hottest market, and economically, I'm not talking about real estate prices because those can operate independently from economics, but the hottest market economically probably in the country is the I-4 corridor in Florida.
Yep, for sure.
And if you guys who are just like, well, that prices are so high, I don't think you understand that every institutional investor that does business in the United States and the world is crawling around on this market for a reason.
That's right.
It's
that's a good point.
It is the place to be. In fact, we're even seeing, we talk about Miami and South Florida being overheated. We're seeing that foreign money that was in South Florida that are now looking at this market and going, you know what, we can still find value here, which to me is incredible. Like getting back to the old folks who've seen this appreciation, but there's a reason for it. I mean, the migration is here, the economy is here, and I don't see it changing anytime soon.
Yep. No, we're working on a deal for German money right now, actually. Family office made their money in Germany, and they've been in Tampa now buying for the last few years, and I think they have 6 or 7 assets under control and growing aggressively, right? So it's pretty interesting. Yeah. To give you one more anecdote, because this one's a great story. We just funded a building in July, right? I think it came into our shop in March. He put it under contract in March. It was 89% occupied in Sanford, right off I-4, just north of Orlando. I think it was delivered in 2017. So very nice property, a $30 million property. We closed that building in July. From March to July, occupancy went from 89 to 97 for this guy. He hadn't even closed on the building. And it's already up to 97% occupied. And so now the business plan was initially get at least, redo some of the finishes, pump the rents $50 to $150, depending on how much capital he did. Now the rents probably are going to be $150 to $200, the bumps he's getting. So just an example of how quickly the market and the rent growth is just, it's crazy here. It really is, in a good way. Who knows how long it lasts, but it's definitely working right now.
Yep.
So Ken, if any of our listeners want an alternative lifestyle, how can they reach you?
Oh my gosh, Steven! Steven,
I couldn't resist.
Steven, come on. This is a family show.
Our website is electracapital.com, and we're all open-minded, free thinkers. So we're into alternative lifestyles as well as alternative lending. No problem there. We're very open-minded to lending to anyone. And and my email's on there. It's just Ken at Electra Capital. Very easy. ELECTRA capital.com. And I tell, and that's a good question. I tell borrowers or buyers, sponsors, reach out to us. Even if there's not a product that fits, we're happy to give you some advice and tell you what to look out for, right? What not to do, who not to deal with, because sometimes that's even as helpful as having a product for you. And, we're always happy to give people guidance, and we like looking at real estate deals. So, feel free to reach out.
Awesome. Steven, anything else before we let Ken go?
Ken, thanks very much for being with us, and we look forward to seeing you.
Yeah, thanks, guys. Let's catch up in whenever, 6 months, a year, you tell me, and we'll do a market update and see how things are going for everybody.
Perfect. And that was Ken Avalos. Steven, Ken came to us from one of our agents, Andrew Abraham. Really happy that he was able to make the connection. I thought Ken was a great guest. Ken's buddies with Andrew now. Andrew's doing a retail brokerage for us. And he's working with some developers right now, trying to get some deals off the ground. Really appreciative for Andrew to making the intro. But Steven, what were your thoughts about Ken and his discussion?
So Ken brings a whole new world to the table. I mean, the sophisticated investors know about the type of financing that he's talking about, but many investors just kind of go forward in the same tunnel.
Take an agency, and that's it.
and aren't looking to see what else is available and outside. And at the end of the day, it's really the returns that you can get. So if you can put in less capital and get a better return, it works out better for everyone.
Or if your deal just doesn't fit in the agency or bank box, but if you can twist the Rubik's Cube a little bit, and in 2 to 3 years it will, but you need that capital to be able to help you complete the deal. This is the way it works. So you see so frequently that it doesn't fit in their box and they just throw it away. I mean, it's so hard to find deals. The more successful you're going to be, the more tools you have in the tool shed to be able to help you twist that Rubik's Cube and get all the colors in line. Stephen, Ken was a terrific guest. Other terrific guests, where might our listeners find them?
So you need to go to our website, www.investfloridashow.com, but also download the app and listen while you're mobile or in the gym or doing whatever you're doing.
Guys, as always, we appreciate the time that you invest with us each and every episode. And until next time, hasta la vista.
You've just listened to the Invest Florida podcast with Eric Odum and Stephen Silverman. Join us every week for actionable real estate investment ideas, and of course, visit our website at www.investfloridashow.com for more shows and tips on how to earn a cash flow in the real estate market in Florida. While hosts and producers of the Invest Florida show have no reason to doubt the validity of comments of our guests, we do not warranty their accuracy. Please check with your legal, financial, and tax advisors before entering into any investment. Returns will vary from person to person and deal to deal based on unique circumstances. All information expressed in this show is for educational purposes only. Opinions of the guests are not necessarily shared by the hosts and producers of the Invest Florida show.